Hello, I'm Daniel Nicholas, and I'm a partner at Evershed Sutherland.
And I'm Maggie Pope, an associate at Evershed Sutherland.
And today we're going to talk about the Base Erosion and Anti-Abuse Tax, or BEAT. BEAT's generally a 10% minimum tax on a taxpayer's income calculated by adding back certain payments to foreign persons.
And this tax only applies to applicable taxpayers, which includes corporations other than RICs, REITs, and S corporations that meet a gross receipts test of $500 million and that exceed a 3% BEAT threshold, which we will get into later.
And one thing to remember is that BEAT is a separate tax, so you don't get a credit on your regular tax for your BEAT tax. And today we decided that it might be helpful to, instead of getting in the weeds on how BEAT applies, to just walk through a simple calculation to see how it applies in real life.
Thanks, Daniel. First, we're going to start with the regular tax calculation. Here you take your gross income and subtract the deductions to get your total income before NOL.
So when you think of a BEAT deduction, think of a payment, a deductible payment out to a foreign-related party.
Yeah. And then you take this taxable income before NOL and you back out your NOLs, and this amount is limited to 80% of taxable income before NOL, which is a new addition in the tax bill. This gives you your regular taxable income post-NOL. You then take this regular taxable income post-NOL and multiply it by the new, lower U.S. corporate tax rate of 21%. You then sum up your credits, including the foreign tax credits, research credit, and low-income housing tax credit, to get your total credits. These total credits are then added to your regular tax pre-credits to get to the regular tax amount of $1.4 million. Now Daniel's going to talk about the little more complicated BEAT calculation.
So in order to calculate BEAT, you start with a couple of pre-calculations. The first thing you calculate is your BEAT benefit, and here on our simple calculation, it really is just your BEAT deductions. Then you calculate your BEAT percentage, and BEAT percentage is used for two things. One is the 3% threshold test that Maggie had referenced earlier, and then the second thing is to sort of transform a portion of your NOLs into a BEAT payment. So here we have BEAT benefit, and it's the ratio of the BEAT benefit over your other tax deductions. Here it's 20%.
And you'll notice this 20% is over the 3% threshold that we mentioned earlier, which means you're in the BEAT.
Right. The next thing you do is you take your allowed NOLs from the prior calculation and you multiply that by your BEAT percentage. So you have 2 million here of NOLs that are going to be characterized for BEAT. Then you take you calculate your BEAT modified taxable income, or MTI. You take your regular taxable income from the prior calculation, you add your BEAT benefit, and you add that portion of the NOL. The next thing you do is you calculate your rate on your modified taxable income. So you take your BEAT modified taxable income and multiply it by the 10% rate. Then you take your regular tax pre-credits, you take away all of your credits, and then you deduct back your research credit and 80% of certain other credits, so as to give you the benefit of those credits for this calculation. Then you compare those two amounts. So here it's the 5.2 million and the 3.2 million, and you take the excess, which is 2 million, and that's your BEAT amount.
Then you take this 2 million BEAT amount and add it to the regular tax amount to get to your total tax amount of $3.4 million.
Right. So taxpayers are thinking of ways of restructuring and other planning opportunities to address the BEAT.
And thank you so much for viewing our video on BEAT today. If you would like more information on BEAT or other bottom line videos, please visit eversheds-sutherland.com. Thanks.